Holy flippity flip flop flap and smokes, everyone. Mortgage rates are skyrocketing and mass layoffs have begun. People, we all know that a recession is here and we are in a recession. But the question is, are we going to be facing a depression? Well, everyone, it is looking more and more likely that we are going to be, in fact, heading for a depression, not a recession by the day. And I've just got some new information for you that you need to know now so you can be ahead of the curve. So ladies and gentlemen, let's not waste any time. Let's get straight into the news, the facts, and the data. Look at this, everyone. This is something that I've been warning about, and this is a critical level for mortgages. The 30-year mortgage rate has now surged to 6.28%, up from 5.5% just a week ago. That's right, it's up from 5% to now over 6% in just a week. And can you imagine what it could be in a month, in 6 months' time? And the reason why this is so crucial is because, like I've been warning about, like many real estate experts warn, for every 1% increase in mortgage rates, your borrowing power for buying a home, because remember, most people don't pay cash for homes, they borrow a mortgage, gets reduced by about 10%. And mortgages hit a low of about 2.7% during the 2020 COVID crash, or when interest rates dropped, and now they're going to be nearly triple that. We're probably going to see mortgage rates above 7% over the next few months. Now, it wouldn't be that bad for the housing market if house prices were at fair market value levels, or if housing wasn't so unaffordable. But we've already seen a massive ramp up in house prices. House prices are already so unaffordable. When you add on these higher interest rates, it is just simple economics. With yield so low on these rentals, it's not making much sense for investors. House prices are going to have to fall. Listen to this. Rising rates have caused a sharp turnaround in the housing market. Home sales have fallen for 6 straight months, according to the National Association of Realtors. And listen to this. For instance, on a $400,000 home with a 20% down payment, the monthly mortgage repayment went from $1,399 at the start of January to now $1,976 today, a difference of $755. And that doesn't include homeowners insurance nor property taxes. And it also doesn't include that the house is about 20% more expensive than a year ago. Now you may think, well, don't worry, because people still have jobs, they'll stay in their homes, they're not going to sell it. Well, people may have no choice but to sell their home, because we are already starting to see the layoffs begin, and we're also seeing surging inflation. So maybe people see they've got $100,000, $200,000, $300,000, maybe $1 million in equity in their home, and maybe they're going to be forced to sell that home to keep up with the rising costs, because we're seeing people's savings rate has fallen from around 20% down to 4.4%. These are depressionary level savings rates, and we're seeing credit card debts climb to record highs. So what this means is people are going to have a huge chunk of equity in their home, and they're going to be forced to sell it to pay off those credit cards and to keep putting petrol in their cars and to keep paying the grocery bill. Because listen to this, everyone. Real estate firms Compass and Redfin announced layoffs as housing market slows. In filings with the Securities and Exchange Commission, Compass announced a 10% cut to its workforce, and Redfin announced an 8% cut. Now you may think, well, that's just the housing industry. There's no other layoffs happening. Wrong, people. It is happening everywhere. I'm sure you've all seen this. Look, Elon Musk wants to cut 10% of Tesla jobs. And with the recent crash of cryptocurrency, we're going to see massive layoffs in cryptocurrency. Coinbase CEO says it's laying off 18% of its workforce. And guess what? With crypto falling even further, it's testing 20,000 right now. You bet it's going to get worse. People, this is a recipe for disaster for the housing market. Mortgage rates rising and layoffs coming. That means people won't have jobs to buy a house, and they're also going to have to sell their house because they've got a huge amount of equity to keep up with their cost of living or to pay expenses while they try to find another job, because inflation is about to get much, much worse. We just got some new data to show what wholesale prices are doing, and this is going to flow onto consumers, because we know CPI is at about 8.6%, but look what wholesale prices just did. Listen to this. Wholesale prices rose 10.8% in May, near a record annual pace. And we all know real inflation is much, much higher than this, but even the official government figures can't hide how much prices are going up right now. And today we're going to get a huge announcement from the Federal Reserve. What will they do? Will they raise interest rates 0.5%, 0.75%, or will they go for shock and awe of 1%? Because many people think that this 75 basis points will be a huge shock or be shock and awe. People, this is not a shock at all. When inflation is now double digits, really what they should be doing is lifting interest rates over 1% at every single meeting to get interest rates above the inflation rate if they really wanted to stop inflation. There's no point of dragging it out. They've already tried that strategy and it's been a losing strategy. Because listen to this, JP Morgan now sees the Fed hiking 75 basis points on Wednesday, that's 0.75%, and sees a risk of a 100 basis point hike, aka 1%. People, this is very, very worrying. And what this means is, you think mortgage rates are high? Imagine what would happen to the housing market if the federal funds rate went to 9%. We'd see mortgage rates of 11, 12, 13%. And guess what would happen to the housing market? It would just simply have to fall in half. That's right, you'd see people's home equity drop in half. We'd see a huge, massive housing market crash. Now, I'm not saying this is going to happen, but this is a risk and this is a scenario we have to be prepared for, because we have to be prepared for all possible scenarios. Remember, people were saying at the start of the year, there's no way the Federal Reserve is going to lift interest rates, or there's no way they're going to do 50 basis point hikes. There's no way they're going to do 75 basis point hikes. Well, now it's happening, people. Remember, people said there's no way the stock market will fall. It's only going to keep going up because of inflation. Well, now the stock market's in a bear market. Remember, people said there's no way Bitcoin will fall to $20,000. Well, now it has, and it may fall below the previous market's all-time high or the previous cycle's all-time high in 2017. And we also just got some new huge breaking news. There is things happening in Europe. And even if you're not living in Europe, because most of my audience are in the US, you have to pay attention to what's happening in Europe, because Europe plays a huge part in the global economy, and it's looking like they're heading for a massive, massive crisis as the ECB, the European Central Bank, is holding an emergency meeting right now as bond yields are absolutely skyrocketing in different parts of Europe, especially Italy. Look at this, world central banks got it wrong and economies pay the price. Policymakers are now moving much faster than telegraphed. Fed and peers hope to contain long-term inflation expectations. And what is this causing? ECB to discuss using pandemic bond purchases reinvest at emergency meeting. The measure was cited as an option in the ECB decision on Thursday. Italian bonds have surged after news of emergency meeting. So what are they going to announce, everyone? We saw Europe have a huge, massive banking crisis in 2008, and what did they do? They just printed money to cover up the problem, but now they can't keep printing money because inflation is out of control in Europe. And there's only two outcomes here. Either they lift interest rates to bring inflation under control and send Europe into a depression, or they try to bail out these failing countries and send the euro tumbling. Soon time will tell. And people, you need to pay attention what is happening around the world, not just what's happening with the markets, because unfortunately, I think the market crash will be the least of our worries. We're already seeing so much other geopolitical issues. We're seeing famine, we're seeing drought, we're seeing blackouts happening in developed countries. I don't even know if this video will get out to you today, because there is risk of the state or the East Coast in Australia of running out of power. Look at this, Australians face threats of blackouts as a power crisis worsens. And the reason for this is because they keep closing down plant after plant. And yes, while it is good to invest in renewables, you don't just want to cut off the coal power overnight, because then you're going to have risk of blackouts. And you know what happens during winter when there's no warmth? Yes, it is not very good for people's health when they seem like they've been all about health for the past 2 years. So people, this was just a quick urgent update. Things are getting worse by the day. It is time to prepare now. If you can, buy more food, buy more daily essentials, because it's only going to get more and more expensive. Keep storing cash on the sidelines. Find ways to diversify your income, because I think there's going to be more layoffs coming, and prepare for what will be a depression, people. I think it is going to come. This won't be a recession. This will be a depression. But if you do prepare, you'll be able to ride out the storm and hopefully help others along the way. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.